Namaskar to everyone. I'm sure the last 2-3 months have been, while it has been a challenging month, I'm also very confident that the way the government of India, the respective state governments, have caught on with various action points to address the growing pandemic, definitely have seen a big progress. I'm sure all of us will be keenly awaiting for the opening up of economy very soon. Every investor in debt always goes through a lot of ups and downs at different point of time. Sometimes some investors enter in the peak of the market. Sometimes some investors enter in the bottom of the market. And while somebody enters in the bottom of the market makes money, is deeply in money. If somebody comes in the peak of the market, naturally he will be out of money for some time. But at the end of the day, in the stock market, what it works, always works. If you look at the Sensex, today is trading around 53,000 or odd numbers, and naturally at the beginning of the financial year, not many would have expected index will go to 50,000 plus. And at the same time, maybe 10 years back, when the index was close to about 7 or 8,000 or maybe 12,000, nobody would have expected the index will go to 50,000 index. So therefore, from investors' point of view who come in, have to of course keep in mind that I'm making this investment not for overnight gain or short-term gain. I'm making this investment for longer-term gain, which essentially means I have to hold the investment as long as possible, which essentially holding it for 10 years and 15 years kind of period if you take, then naturally anybody who comes in the peak of the market will get averaged out in the form of the incremental investment that he'll be making, and that will help him averaging out his own investment. At the same time, the power of compounding that exists in the equity market ultimately helps him make the much needed income out of or maybe the gain out of such investment. See, the asset allocation for everyone remains more or less the same on the basis of the expected return that could expect from every asset class. So the traditional way of doing asset allocation, which is you take about 100 rupees, you put 40 rupees in equity, 50 rupees in debt, and then keep doing a rebalancing at a continuous interval, depending upon how much is the risk capital that you have. Second is, in a falling interest rate scenario, or when the interest rates are low, you need to also get asset class that can give you better than fixed income, right? That would be one of your objective. That being the case, and another way actually one can look at the asset allocation, what is the likely return that one can generate, whether it is in equity, or in the fixed income schemes or mutual funds, or in fixed deposit, or in gold, or in any other asset class that you may want to buy, like such as real estate. Then you put each asset class and put the expected return on each of the asset classes, and then arrive at on the total basket. How much of that on the basis of the expected return, increase your weightage towards those assets which can give you better than the other asset classes. At the same time, ensure that you have investments in all the 3 or 4 asset classes. That's one way to manage your asset allocations. See, one of the interesting observations that I have, in the last 1 year during the pandemic period, the number of people who have tried their luck in the equity market, direct investing, have benefited big time. There is absolutely no question on that, because they have not seen a falling market, they have seen one side up market. Any investors is always easy to make money in the rising market. And millennials especially have not seen cycles. Probably they would only read it about cycles, they have not seen cycles. And therefore the millennials, as time progresses, having now tasted the experience by investing in equity directly, eventually my own personal belief is they will also have to graduate themselves into the mutual fund product, given the fact that when you buy a security in the market directly, you buy one security or 2 securities or 3 securities, you don't buy a basket of securities. Whereas the mutual fund gives the benefit of diversification, not just only in investing in a single security or one sector, it invests in multiple sectors, it invests in multiple stocks, therefore it gives a diversification benefit in the portfolio. Therefore I would assume all the millennials who are now got into the equity market investing directly during the pandemic period, they need to also gradually move towards mutual fund and diversified their own investments by investing in mutual fund as well. So that is the way I would assume that the whole journey will begin for millennials. I'm only glad that each one of them who got into the equity market investing, that is good they have begun, it's a good beginning and it's not the end. And this beginning of investing in equity would take them further by making them invest in mutual fund as part of their overall diversification, building the future portfolios depending upon the goal that individuals may have. As my concluding remark, I would of course encourage each one of you to get vaccinated for yourself and your family members, and also pray to the God for giving all the health and all the strength that one may need in this kind of challenging times in managing both the family affairs as well as the broader aspects of driving the economic growth. Stay safe and stay healthy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.